Good morning. It's 11 o'clock. Welcome to the webinar. Selling Your Business in 2021 is co-hosted by PM Corporate Finance and Greene. Thank you for taking time out of your busy schedule to join us today. So before we start the presentations, I'd just like to say that we will run to time, finish at 12 noon. This session will be recorded. The recording and the slides will be made available after the events. And there will be questions and answers at the end of the presentations. So thanks for the people that have submitted questions already. And if you would like to submit a question at any time during the presentations, please use the Q&A chat box on the toolbar at the bottom of your screen. Quickly, just on the agenda, Ned Brown will lead, just looking at state of M&A in 2021, valuation and funding. Philip will just take us through a couple of processes when it comes to selling and using case studies to illustrate that. Andrew will take us through some of the legal aspects of exiting, and will focus on employee ownership trusts. Jan will just look at what was presented at the budget and also share some tax tips and planning for a tax efficient exit. And then Lake will just look at really rebooting your strategy for 2021, exit planning, and making a useful comparison between MBOs and EOTs. There's a lot of chatter around that at the moment. So yeah, Q&A to follow at the end. So Ned, it's over to you to start the presentations.
Thanks, Shaun. Morning, everyone, and thank you for joining us today. I'm Ned, a manager, PM Corporate Finance. Today, I'll briefly cover the M&A market, taking a retrospective look at the impact COVID had, and then looking forward to why businesses and funds are making acquisitions at the moment. We'll then look at current valuations using a number of industry metrics, and finish off with current funding options for acquirers and for raising growth capital. So this graphic here is from Mark to Market. It illustrates the number of monthly transactions from Feb 20 to Jan 21. And as you can see, we saw a sharp decline over the March to April period during the first lockdown, especially number was barely halving deals done from 406 to 187. We then saw a steady, almost month-on-month increase from the peak or up to December 20 at 460, and then a drop-off in Jan 21, which is quite usual post-year end and sort of over the holiday period. So overall, there's lots of activity in the market across a range of sectors. This slide here briefly looks at current M&A drivers. According to this EY report, the main driver for increased M&A activity is making bolt-on acquisitions. This is acquiring smaller companies in the same sector to increase market share, bolster perhaps weaker offerings of the company, and other strategic reasons. The pandemic has been a reflective period for many businesses and has highlighted weaker areas. Performing strategic bolt-on acquisitions is a quick and effective way of strengthening weaker aspects of a company. And this is exactly the case we saw end of last year. We sold a business called NJOG. NJOG were acquired by a Swedish trade buyer who were trying to get into the UK primary care market. It's quite a hard market to break into, and NJOG controlled about 60% of the UK GP market. As a result of the acquisition, Greene, the Swedish trade buyer, an instant foothold in the primary care market. And the EY report also suggests that 57% of UK corporates are looking to make an acquisition in the next 12 months. So there's lots of appetite. This is funded through cheap debt and potentially relatively well-priced businesses. So coming on to valuations, the basis of valuing a profitable company has not changed as a result of the pandemic. When valuing a profitable business, one normally uses the market method. This is using a profit metric normally earnings before interest, tax, depreciation, and amortization, EBITDA, and multiplying that by a multiple which has been gathered from comparable listed companies and comparable recent transactions. So the profit metric times your multiple results in an enterprise value, essentially the total value of a business. This then needs to be adjusted for the capital structure of the business, very simply adding cash, subtracting debt, but also ensuring there's a normalized level of working capital that remains in the business. This then results in the value to the shareholders, which is called the equity value. So these are the three main variables when valuing a profitable business. The next few slides, we will look at three valuation indices, the FTSE 100, the FTSE 250, and the FTSE All Share as comparables. So first of all, profits. This chart illustrates a sharp decline in EBITDA growth over the last year on the back of the strong growth of the previous 2 years. So profit in general is down. EY reported that 92% of businesses have had their profit negatively affected by the pandemic. So the key here as a business owner is to understand the wider market context. If your profitability has taken a hit, then as expected, and if it's remained flat or even grown, then this is outperforming the wider market, will increase the value of your business as it demonstrates resilience. It's also key to measure the impact of COVID and that impact on your business. This monetary value could be added back to your EBITDA to normalize the profit on a sale. So coming on to multiples, this chart illustrates the enterprise value to EBITDA multiples that the three indices are trading at over the last 12 months, as well as two transactional indices, the Private Company Price Index and Argos. Overall, following the trends above, there's been a sharp decline in April of last year's multiples, and that's continued then to rise up to where we are now, with the FTSE 250 trading at a 12.8 times EV/EBITDA multiple, so really quite high, higher than the last couple of years. The reason for this really is that the increased multiple counteracts the lower EBITDA figures we saw on the previous slide. This actually demonstrates that actual valuations of businesses have held, and ultimately when selling a business, it's about price. It's something we push quite hard at PE and Corporate Finance, is really having a strong narrative around the value drivers of the business and not just looking at the financials. So lastly, I've only looked at debt levels here for equity value adjustments, but it gives you sort of a bigger picture of the wider context. As to be expected, debt levels have increased in each of the three indices as a result of the decline in profitability, but also the increased access to government borrowing. The key takeaway here is for business owners to understand key adjusting figures in the equity value bridge, the company's debt and cash levels, but most importantly, the working capital cycle. When building up to a sale in the long term, are there tweaks that can be made now to your credit terms or debtor days to boost the ultimate take-home money after a sale? And just to wrap up the valuation takeaways, profit, analyze your profit in detail, quantify your COVID impact, and sell growth. The acquirer is buying the future business to sell that profitability. Multiples do benchmark, as we've done so above, but ultimately it's about price. So know your price and worth of the business. Equity value, analyze your working capital ahead of a sale and your cash and debt, and maximize the cash off the table. It does make a big difference. So we will quickly look at funding options for buyers and also for businesses looking to grow. The key takeaway here is that we're not in a credit crunch like the last recession. There's more money available here than there ever has been, actually. Debt is still very cheap, and the private equity funds need to deploy their capital within a certain time frame, so they're desperate to make acquisitions. Just running through the list here, the high street banks, they're open to new customers again after a long period of closed doors. There's a raft of alternative lenders of increasing flexibility when it comes to structuring their debt offerings. Then there's a private equity offering minority, majority investments, and also full acquisitions through bolt-on acquisitions. And then finally, the last funding option there, there's always the possibility to fund a sale yourselves through vendor loan notes or simple debt. So just wrapping up the last few slides, the M&A market is active across most sectors. Obviously, some, such as hospitality, have been hit hard. Valuations have held or increased, but make sure you know your price. And there's lots of funding available. This is not a credit crunch, so it's a good time to be looking for a sale. Thank you, and now pass over to Phil.
Thanks, Ned. Good morning, everyone. My name is Philip. I'm a director here at PM Corporate Finance, and today I'll be covering off full auction and what's involved. I'll also be covering off a negotiated sale, and I will run through a couple of case studies of recent sale mandates of ours, namely the sale of Shell Instruments, which was a full auction, and the sale of Unique Employment, which was a negotiated sale. So certain terms are hugely interchangeable in our field of corporate finance. Terms such as M&A processes, disposal, trade sale, all of them really are pointing towards an exit. And what I'm going to talk you through first today is a full auction for clarity. So a full auction is essentially a controlled process with a wide range of potential buyers contacted, either financial or trade buyers contacted. It's controlled in a sense that confidentiality is maintained throughout. Through the process, we're able to stimulate a sense of competition amongst the buyers. The process is a reasonable market test for your business, and if planned correctly, can be a really efficient method of exiting the business. And look, in the same way, there are no two identical businesses. There are no two identical sale processes or identical full auction processes. However, a good controlled auction will include these 5 elements that are on the page right now. So planning, this is a review of strategy and timing. Here we analyze value drivers and assess value of the business. Here, initial buyer research is carried out. Now, who would be interested in acquiring your business? Next, we've got packaging. This is where we prepare the business for sale. We draft what's known as the information memorandum, which is essentially the company's selling document. And we just get things ready to go to market. So the third stage there is marketing. This is where buyers are approached confidentiality, with advisors soliciting indications of interest in acquiring the company. This phase may also include management presentations, and here it's an opportunity for the vendors to review the buyers across the table. The next stage is selection. Here we evaluate the offers, we leverage competitive tension and select the preferred bidder. And finally, we've got closing, which Andrew will come to talk about in the next section. Here we've got due diligence here, where the buyer lifts the hood essentially and confirms what they are buying. Legal governing documents are also drafted, so a good corporate lawyer like Andrew will need to be engaged. So what does one look like in real life? In 2018, we were engaged to sell Shell Instruments, a privately owned business engaged in the design, testing and manufacturing of sophisticated instruments for the measurement and control of gas pressures and flows in a wide range of applications. That is a mouthful, but there you go. Essentially, highly bespoke and sophisticated instruments was their game. And in terms of applications, not least in the aeronautical market, hence the picture of a plane engine there. It was quite an extensive marketing process we carried out. We contacted more than 100 buyers, both in terms of domestic buyers, overseas buyers. We had a large number of private equity houses that were interested in acquiring this business. There was plenty of strategic interest in acquiring Shell Instruments, as evidenced by the request for the information document, which we drafted with the clients in advance. So it was a really tightly managed process. We had multiple conversations happening in tandem, but essentially, as Ned said in the previous presentation, we were trying to maximise the price for our client. But not only price maximisation, it was about finding the best home, the right home for Chell Instruments to kind of continue with the growth trajectory and mining the market opportunities and what have you. So after fully leveraging that competitive tension and successfully negotiating a deal that was appealing to the vendors, we sold the business to a company called SDI PLC. It's an AIM-quoted, Cambridge-based group of different kind of instruments, businesses, and what have you. The process from start to finish lasted 15 months, and so pretty extensive, but it was a good outcome for all involved. So that's the full auction. What about a negotiated sale? So essentially, a negotiated sale is where advisors lead one-on-one negotiations with a single buyer, typically making an off-market approach, right? Negotiated sales are an alternative to the full auction. As I've mentioned, at a full auction, you've got multiple buyers that are approached in order to yield the most choice, introduce competitive tension, and maximise the eventual price paid for the business, as I kind of laid out with Chell Instruments. However, a full auction takes time. I mean, 15 months was the case for Chell. Typically, we're talking about 9 to 12 months from start to finish. It can be costly in terms of fees, as well as disruptive and distracting to a business. No matter what plans you put in place, sometimes the prospect of selling your business can overtake the vendor's thoughts on a day-to-day, right? But one thing is absolutely for sure, negotiation support will help with deal structuring, responding to buyer queries and eventual offers, clarifying what things mean, and negotiating better terms for the vendor. So what does one look like in real life? Here's a quick case study. In late 2020, we helped to sell Unique Employment Services, the privately owned temp recruitment business, about 22 million revenue. And we sold that to a Madrid-based multi-sector consolidator called Job and Talent. Unique received the off-market approach from Job and Talent, and we helped to negotiate valuation. We helped to structure the deal. We got the deal to heads of terms, and we acted as a liaison point on due diligence, and we helped the lawyers with the drafting of the commercial aspects of the transaction. The vendors weren't expecting an offer or an approach, but they was just starting to think about, selling eventually. And so when they got the approach from Job and Talent, it just sort of accelerated their thought process. And so we were helpful in getting Job and Talent to a number that made sense for everybody around the table. And it was a successful outcome for everybody. So to wrap up this section, whether it's a full auction or negotiated sale or somewhere in between, my advice would be to get some advice, because DIY deals, do-it-yourself transactions, they just take longer to complete, and they're messy, and it's quite difficult for a business owner to run their business and try to transact at the same time. Get your house in order, delegate effectively to separate operational responsibilities from deal-related tasks. Information flow can quickly become a bottleneck on deals, so take the time to get the right information right at the first time of asking. Nothing erodes confidence like reverse engineering, and I've seen it happen so many times before. Above all, similar to what Ned laid out in his section, have a number in mind, have a walkaway number, and know when to say no. Thanks for listening, guys. I'll now hand over to Andrew.
Thanks, Phil. Morning, everyone. I'm Andrew. I'm a partner in the company commercial team at Greene Solicitors. I'm just waiting for the slides to catch up. Yeah. So in this section, we're going to look briefly at some current trends or points in the legal process. We'll touch on due diligence, the ever-increasing use of earnouts, and the growth of employee ownership trusts. So in terms of changes to the due diligence process first, there are a couple of areas where buyers will now pay more attention or be applying additional focus. And whereas a seller, it's good to get your ducks in a row prior to the DD process starting. The first one of these is around the furlough scheme. Anyone who's operated the furlough scheme over the last 12 months will know just how complicated it can be. A buyer is going to want to check your records to ensure that you've made proper claims and that everything's in order. So just get that into order in advance. Make sure as far as you can, you've cleared up any anomalies. Another area that buyers will always look at are commercial contracts, but over the last 12 months, several areas have been sort of brought into focus by the developments. So buyers are going to be looking now at, in particular, force majeure clauses in your contracts. How did these operate during the pandemic? Did they work as intended? How might they operate in similar scenarios in the future? The pandemic has also brought into focus some of the difficulties in dealing with consumers and how you might not be able to rely on your contractual terms with the consumers, for instance, terms around cancellations and refunds. So buyers will be paying particular attention to that. And then also, of course, there's the effect of Brexit, not as bad as it might have been if we not had a deal, but buyers will still be looking for international contracts, looking at issues around tariffs, issues around who's responsible for customs paperwork, who's responsible for changes in regulations if goods are being sold cross-border, and also checking who's responsible for sort of delays at border crossings. So with this, the best point to take away is to review your contracts as far in advance of a sale process as you can, and to understand any weaknesses you've got, and to try to make changes as far as possible. So another trend, which has been around for quite a while now, but will continue to increase in popularity, is the use of earn-outs to combat uncertainty around how the target business will perform post-completion. So an earn-out is where part of the consideration is linked to some performance criteria of the business post-completion, as opposed to simply deferring a fixed amount for payment at a later date. As a seller, there are a number of key factors to consider when you're negotiating an earn-out, and some of these need to be considered at early stages during heads of terms. So the first one is the obvious one, which is you obviously need to consider the proportion of the consideration that's going to be fixed, and the proportion that will be based upon performance. Also consider the time period for the earn-out. We see anything from between 1 to 4 years. It's quite common. Clearly, as sellers, you're probably going to want that to be shorter as possible. Also consider what the actual performance criteria is. Often it will be linked to EBITDA or net profit of the business, but not always. Sometimes it will be linked to the performance of a particular section of the business, or maybe income received under a certain group of contracts. Whatever the performance criteria is, it must be capable of being objectively determined, if necessary, by an independent expert. If your earn-out is linked to profits or EBITDA, carefully consider what adjustments might need to be made to these over and beyond how they're reported in the statutory accounts. So, for instance, if as a seller you know that you've got one-off costs coming down the line for certain projects, should these be excluded? This is something that will obviously be very fact-specific, case by case, and to be negotiated with the buyer, but it's good to have it in mind at the outset. You also need to consider what control you've got on the performance of the business and achieving the targets set after completion. As a seller, are you still involved in the business, or are you completely reliant on the management team? And is that the existing management team or a new management team? If it's a management team, how are they incentivized to perform? Do you, for instance, need to try and negotiate a bonus package for the remaining management team to ensure that the business performs well? Also, watch out for where payment is linked to your, if you are remaining involved, watch out to where payment is linked to your continuing involvement. Buyers will often say that the earn-out will simply fall away if you cease to be employed or engaged in the business. That can create tax problems. There's a whole range of criteria to consider, but occasionally, if an earn-out is structured in that way, the earn-out consideration could be treated as income rather than capital. So it's something to watch out for at the heads of terms stage and to take advice on that before agreeing to that in the heads of terms. And there'll be a raft of other protections needed, requirements for the buyer to continue running the business in the ordinary course, possibly restrictions on the buyer disposing of significant assets, and they're all to be negotiated during the legal process. So next, a look at employee ownership trusts. EOTs are starting to become more common. They were actually introduced in the Finance Act 2014, but we've seen a definite uptick in inquiries over the past 2 years and are expecting to see these continue to grow. There's been some high-profile EOTs relatively recently. Richer Sounds moved to an EOT structure in 2019. Arup, the engineering firm, did so just before that as well. So how does an EOT work? Well, we've got a diagram here on the screen. Essentially, the company will usually set up a trustee company, which will be the EOT, and then the sellers will sell all or a majority of their shares to the EOT. The EOT will then hold those shares on trust for the benefit of all the employees of the company from time to time. The consideration with the sellers will usually be agreed on day one, but most or all of it will be left outstanding. The EOT will then be dependent upon the company making capital contributions or otherwise advancing funds to the EOT from the company's trading profits in order to allow the EOT to make the payment to the deferred consideration to the sellers. So why are EOTs attractive to sellers? Well, one of the big plus points at the moment is that when the sellers sell into an EOT, they will not pay capital gains tax. So clearly, with the relatively recent restrictions that were put in place last year on entrepreneurs relief or business asset disposal relief, and also the seemingly inevitable increases in capital gains tax, this is a big plus point. Also, the valuation at which the shares are sold into the EOT will often be worked out using independent valuation. So you can have confidence of selling at or close to a full market value rather than having to negotiate with an arm's length third party in a potentially difficult market. The downside to the EOT are that principally it's difficult to reverse. So once you've put it in, the capital gains tax is rolled over. So if the EOT wanted to sell shares in the future, they'd essentially pay tax on the uplift between the acquisition price for the seller and the sale price for the EOT. There'll also be administrative costs for operating that kind of structure. And sort of generally, the EOT benefits all employees. So it won't work particularly well for businesses that depend heavily on a few incentivized managers or owners to drive it forward, who are going to be incentivized by the future prospect of a sale. And it doesn't necessarily work so well for businesses that are likely to be continuously acquired in the future, again, because of the difficulties with the CGT rollover. So where we're seeing it really benefits firms are those who are not naturally likely to be purchased on a cycle, and where they've got a kind of broad employee management base and they want to increase the involvement of those employees. For example, we've seen quite a large uptake of EOTs in architects firms and planning firms, which would fall into that category. So that's everything from me, and now I'll hand over to Jan.
Thank you, Andrew, and good morning, everyone. Just a brief introduction. I'm one of the tax partners at BEM, and in the last 20 years, I've been mainly advising on corporation tax and specifically on transaction tax. So today I'm going to cover 3 areas, just an opportunity to go through the budget, which was presented earlier this month, and really things that are specific to businesses, and also give you an opportunity to go through the capital gains tax potential changes that we might have on the horizon. Before doing a sale, there are a lot of things that you can do to really help your business, making sure that you claim tax reliefs and so on. And finally, I will cover as a third and finally how to achieve a tax efficient exit. So I think in terms of the budget, there was a lot of nervousness before the budget, I think with unprecedented levels of government borrowing necessary to support the economy with COVID and everything. And there was a lot of concern that we would see rises in capital gains tax and also concerns about business tax changes. For the time being, the capital gains tax changes have been put on hold, but there was a lot of business tax changes The first one really being that corporation tax rates will change with effect from 1st of April 2023, and they will rise quite significantly from 19% to 25% when taxable profits are over £250,000. So I think that's quite an important thing to think about if you're doing a trading asset disposal. That could be quite a significant increase in the disposal costs. There's going to be a small profits rate, but it's only going to kick in at £50,000, and there's going to be a band between 50,000 and 250,000 where profits are taxed at 26.5% as a marginal rate. So that's going to be a significant increase. But it wasn't all doom and gloom. What they had also announced was extension to the loss carryback rules. So if you're making a loss, and there are 2 periods that are going to be looked at. So if your accounting period is ending between 1st of April 2020 and 31st of March 2021, and there's a second period between the 1st of April 2021 and 31st of March 2022, you will be able to extend your losses back from 12 months to 36 months. And in that 2-year period that has the extension, you can offset up to £2 million of losses. So I think that's a welcome introduction and definitely going to be helpful to a lot of businesses that have been impacted by COVID. The other thing is really to try and encourage investment. The Chancellor actually introduced some measures that we haven't seen before. There is a super deduction, which is coming in from the 1st of April 2021 of 130%. So any eligible plant and machinery, rather than getting depreciation, you have a tax allowance that is 130%. So if I spend £100,000, I can actually claim £130,000 in the tax computation as an example, and actually that means that you get a £24,700 saving. So that's a 24.7% tax saving on expenditure. But it's only going to be for 2 years, and it finishes on the 31st of March 2023, which coincides with the increases in corporation tax rates. So you have to be very careful when you get to that period of time. But we've got a full budget webinar recording on our PM website if you want to find out a bit more. Just before the budget, there was a Office of Tax Simplification Capital Gains Tax Review, and the OTS is part of the Treasury, and actually the director of the OTS is a gentleman called Bill Dodwell, who previously was head of the tax policy group at Deloitte. He was also president of the Chartered Institute of Taxation, and he's very well respected. So a lot of the recommendations, I would expect there's going to be some changes in the future. And there were 11 recommendations, and there were 3 actually on the face of the website. And I think these are ones that you need to bear in mind if you're looking to sell a business. So the first one on rates, Bill Dodwell of the OTS said that if the government considers the simplification priorities to reduce distortions to behaviour, it should consider more closely aligning capital gains tax rates with income tax rates, which alarmed a lot of people, understandably. On business reliefs, Bill went on to say that the OTS considered that business asset disposal relief, which was before entrepreneurs relief, is mistargeted if its objective is to stimulate business investment and risk taking. The government should consider replacing business asset disposal relief with a relief more focused on retirement. And the third recommendation that he made as part of the report was the government should consider removing the capital gains uplift on death, and instead provide that the recipient is treated as requiring the asset at the historic base cost for the person who's died. So I think a lot of planning, certainly family planning, has been to pass on the assets on death, and that's possibly going to be removed in the future. In terms of capital gains tax, we're talking about aligning with income tax rates. We've seen that in the past. You know, we had a period of time when we had capital gains tax of 30% when it was CGT was introduced in 1965 to 1988. Those were aligned in 98 to 2008 with income tax rates. But I think that doesn't really give you the full story. There was a lot of other reliefs. You know, we've got the annual exemption, which is a small amount for administrative reasons if you're disposing of assets. And we also had a retirement relief that exempted a certain amount, and then you would pay capital gains tax on 50% of the value above a certain threshold. We've had indexation allowance for inflation, and we had taper relief before entrepreneurs relief, where only a quarter of the gain will be taxed. So that was the effective rate of 10%, and that was carried across into entrepreneurs relief, where you had £1 million and then went up to £10 million, and then in the 2020 budget, that was reduced to £1 million. So I think we are seeing a lot of changes, but I think with the deficits and the borrowing, we are expecting capital gains tax rates to rise in the future. So I think in terms of the next part of today's talk is really what can business owners do before a sale, and Ned briefly touched on the value drivers, and these are really sort of various internal and external factors that affect the performance of your business and the value of your business. And I think, again, for tax purposes, there are a lot of things you can do, and people are very much aware that employees are the most valuable assets. And it's important that if you can, is to tie them with share options, and just one of those, the enterprise management incentive, is actually enables management to benefit on very similar terms to business owners. So they're tied into the business. They have the right to acquire the shares at a future date based on their current value. Any growth in value is subject to capital gains tax, and if they're held us for 2 years, they can also benefit from entrepreneurs relief. And actually, the proportion of shares they need to hold is much less than a business owner would need to have to qualify for business asset disposal relief. The other thing that is really worth looking into is innovation. There's a lot of tax reliefs if you're doing a new product, process, or software, or improved product, software, or process. Then you should really be thinking about R&D tax credits, because companies get an enhanced deduction. So for tax-paying companies, that's a 43.7 pence to the pound saving, and if you're loss-making, you can surrender for cash back of 33 pence to the pound back from HMRC. So it's very beneficial. Also, the patent box is something that's worth thinking about. That's a 10% rate, and especially with the rates going up, that's something that people need to think about. Capital allowances I touched on, the super deduction, and also just tax losses are valuable assets, and particularly people looking to acquire a company, or if you're looking to sell the trading assets, you can shelter some of the profits chargeable to corporation tax with those losses. So these are all things that you need to think about going forward. So in terms of the third and final part is really looking at how you can exit a business. There are a number of ways. Sale of business to a third party, which has been touched on, and management buyouts are going to be the two ones which I'm going to focus on today. Company share buyback are quite rigid, and typically would involve if one of the shareholders is looking to exit. I'm not going to cover in any detail today. And we've also touched on EOTs, which Andrew has done, and Lake will do so as well. But I think the key thing, there are some sort of key things to think about when you sell a business. It's really, there are three things that I would sort of say is it first of all an asset sale or share sale, and that can have a considerable impact on what you end up with in terms of the consideration. And I think that's a really key thing to think about. Is what are people going to look to acquire? And I think at that point in time, if you've got multiple activities or assets that might not be acquired, you might want to separate those out to make it much easier to sell in a tax efficient manner, because the ultimate aim is to get your disposal proceeds subject to capital gains tax. The best way to do that is to just show you what happens in the two scenarios by way of an example. So in terms of an asset sale, the issue that we have is a double tax charge. So what happens is the company disposes of the assets. Let's say here it's £1 million. Those will be subject to corporation tax, currently at 190,000, might be greater in the future. And it could be all attributable to goodwill. So you've internally generated that goodwill. There is no base cost to it. So you pay tax on the full amount, and the proceeds that within the company after tax are 810,000. At that point in time, you still haven't received those proceeds, and you might have to take them out by way of a dividend. And at the highest rate, it's 38.1%. So that's another £309,000 of income tax. And there might be reasons, you could wind up a company, but there might be reasons why you can't wind up the companies, because there are other activities or assets that are being held, and you can't wind up the company, or there are other activities you're carrying out, and there are various anti-avoidance provisions to stop you from winding up the company. But in that situation, you end up with half the proceeds, which is not particularly efficient, and certainly not the 10% that you were expecting on a sale, and certainly a sale that you would do if you were doing a share sale. In this situation, again, someone comes along, £1 million, but this time for the shares in the company, and you pay capital gains tax at 10% if you meet all the conditions for business asset disposal relief, and you receive proceeds of 900,000, which is much better than the first example. And even if you do not qualify for business asset disposal relief, currently you'd be paying 20% capital gains tax. So again, it's definitely worth thinking about the structure of your business. Management buyouts, again, very similar principles. What happens is that vendors dispose of their company to a new company, which is being set up by management. But I think you have to be very careful because HMRC look at those structures very carefully. If, for example, as a vendor, you have a continued interest in NewCo, if that's quite significant, then HMRC is saying, well, indirectly, you're still owning the underlying company and will refuse you the capital treatment under transaction securities legislation. And also, there is also an element of, in a lot of cases, of non-cash proceeds, loan notes. In those situations, we also go for clearance to make sure that everything's deferred into the loan notes. And then you can decide how you want to tax that going forward, which I'll go into in a bit more detail. And the key thing is really to go for HMRC clearances. And those have been particularly taking quite a lot of time recently. So I think if you're planning sale, also leading up to the budget, it's really worth planning well ahead. I think this year has been an exceptional year. We've had a lot of clearances and HMRC were taking their full 30 days to respond. So we had a few that just came in just before the budget and clients were keen to get that just because of the uncertainties around capital gains tax. So I think in terms of business asset disposal relief, just for those who are not aware of the relief, it's effectively, it was entrepreneurs relief and it's basically 10% rate of capital gain tax on £1 million of lifetime gains. You have to broadly have a 5% interest in the business. There are various tests for that. You have to be an officer or employee and the company has to be trading and you have to meet those conditions for a couple of years. With a reduction with the lifetime limit, it's definitely worth looking at spouses and family members and whether they should be also having shareholdings in the company. It's really quite important to do so sooner rather than later. There are also things to think about in a lot of cases where you have non-cash proceeds. Andrew touched on earnouts. It's the right to receive a future sum as well for capital gains tax purposes. It's important to do a valuation of that because that's brought in. And effectively, you need to claim that amount so you can claim business asset disposal relief. And then if you receive more in the future, then potentially that's not going to be eligible for business asset disposal relief if you're outside of the claim window. If you receive less, you can go back and amend your self-assessment tax return. The other thing that you need to worry about as well is if you get share for share exchange or share for loan notes, whether those shares and loan notes will benefit from capital gains tax rates if you no longer qualify for business asset disposal relief. And in those cases, you can do elections, or you might sort of say, actually, what I would like to have is rather than loan notes, I want to have deferred cash or simple debt instead so that I can secure my capital gains tax rates and reliefs at the point of disposal. So I think these are things that can become quite complicated, and a lot of advice was flipped on its head before the budget because actually rather than having deferred consideration, a lot of people wanted to be taxed up front and made all the various elections, and that's I'm expecting to carry on with the trends that we're expecting to see with capital gains tax. So hopefully that's given you a good overview of the budget and the capital gains tax review. I think that's going to be something that's going to be looked at over the next few years. I know that Rishi is pro-business, but I think unfortunately we are going to have to raise taxes at some point in the future. Also, it's important to think about the value drivers for various reasons for valuations and when it comes to sale, and really whether there are things you can do from a tax perspective to claim tax reliefs, and really just making sure that you've planned for your exit well in advance, several years, a couple of years in advance is the ideal window to make sure you look at the structure and also business asset disposal relief. That's great, thank you. I'll pass you on to Lake, who will go through on MBOs and EOTs. Thank you.
Thanks, Jan, and morning, everyone. I'm Lake Falconer. I'm Corporate Finance Partner at PEM, and this morning I'm going to talk about how you might go about rebooting your strategy for 21, exit planning, and then do a critical compare and contrast of buyouts versus EOTs when you're thinking about succession. So moving on to look at the strategy. I've got 10 thoughts for you to get your strategic planning rebooted. So number one, take the long-term view. We've all been in survival mode. We need to get the head up and look longer term. Number two, embrace uncertainty. Plan for multiple scenarios. I think traditionally people look at best case and worst case. that may now not be enough in terms of scenarios. Number 3, reconsider what's possible. I'm sure we've all got stories of businesses that pivoted during COVID. I guess my favourite one is a client of ours, Kale and Damson, which supplies fantastic fruit and veg to the restaurant trade, pivoted into direct consumer. And I've certainly been enjoying their produce. Commend that to you if you're in and around Cambridge. The point being, it's an inflection point. It's time to challenge the orthodoxy in your business. Number 4, people talk about the new normal. I think, unfortunately, we're now into the realms of the never normal. So you need to keep thinking about disruption. Stress test your business ecosystem. Have a real think about what your competitive advantages and how protected it might be. Number 6, think about resiliency. That's going to be what future survival hinges on. So when you're thinking about investment or acquisition, it's not just about profit and growth, but about diversification and flexibility. Number 7, anchor your 2022 plans on 2019, not on 2020 or even 21, which is probably going to be a transitional year, bit of a mixed bag. Number 8, think about how your business really makes money. What are the critical differentiators? Number 9, who do you depend on to drive the business? Think about who the most important stakeholders are and their behaviour and how that's going to affect you. And then number 10, finally, what are people's behaviours going to look like after the pandemic? You know, at the end of the crisis, some things are going to go back to the way they were. Some things are going to look different, and some things are just not going to come back. And the trick, of course, is to try and work out which is which. So there's some inputs to your strategic thinking. Moving on again now to look at exit planning. This very much depends how far off you are for your potential exit as to what kind of review we would typically do with businesses. 2 to 10 years out, we think in terms of an exit planning review, 18 months to say 3 years, more of an exit readiness scan. So what do they involve? Well, an exit planning review is very much getting under the bonnet to look at what are your personal drivers as business owners? What's M&A activity like in your industry? What are your trading prospects like? Value drivers, Jan and Ned have both mentioned them. These are the things that will impact the multiple. What are they for your business? How will a buyer look at your business? Obviously, valuation is important. Valuation now, and then when will the business reach your target valuation? What exit choices do you have? What's practical? What's preferred? In today's sessions, we're talking about buyouts, employee trusts, and trade sales, but you might also think about private equity or even flotation. And of course, timing. When will the business be ready to achieve what you want it to achieve? And what you should get out of a decent exit planning review is a series of key strategic objectives and actions aiming at them with ideally someone's name and a date against them so that you actually get some real traction, something happens out of it. Now, as you get closer to exit, you probably will think about an exit readiness scan, close enough to have visibility of the market, the business cycle, but far enough out to be able to actually tune the business before you get there. And the key questions are, is your timing still right? What about the market? What about valuations and trends? Is your originally planned exit route still practical and preferred? Are there any other performance improvements that might allow you to capture value? And then have you got a pipeline of value creation ideas that could extend after the sale to the new owners? It's always good to leave gold in the ground for the next guy because it's that potential that leads people to pay top dollar. So moving on now to compare and contrast buyouts and employee ownership trusts as routes to succession. So I'm going to focus on succession buyouts where the vendor initiates it to sell to his or her team. And if you have a stable, profitable, growing business, that's very much a viable option. Basic structures probably familiar. Company gets sold to new shelf company. So you would hope to get capital tax treatment, as Jan has talked about, 10 or 20%. And it's funded by cash in the company, debt, loan notes from the seller, and possibly private equity. Management invests some cash to make sure they're committed. And there is loads of funding for this right now, as Ned mentioned. If you are thinking of doing one, what I wouldn't suggest is just let your management go and have a go. It's one where it's better if you structure it and take a good deal to them. And in these COVID times, scenario planning and making sure there's loads of cash flexibility is probably important. You don't want to burden the business. So next, moving on to look at employee ownership trusts. John Lewis is very much the poster boy for employee ownership, although in fact it predates the trust legislation by quite a bit. Andrew has covered this. Very tax effective for the vendor. It's about long-term employee ownership, but quite unfavourable tax treatment on a subsequent exit. Funding is pretty similar to a buyout, although private equity is probably more difficult because of the lack of an easy exit. Employees enjoy a nice tax-free bonus. And to do one, it has to be a company that benefits all employees on the same terms, and it must be a trading company. You need, I think, to think about cultural suitability. It may need a different culture if it's being genuinely all employee. And I guess I would question, do employees feel any different motivation-wise? Do managers have skin in the game? You need to value your continued independence, because the disincentive to sell may act as a poison pill and limit your objectives. So moving on to compare them really quite specifically, just to pick out some of the key points in this. The key differences, I think, are tax. EOT better on the way in, but buyout much better on the way out. Senior team motivation, I think it's probably better in a buyout because they have real skin in the game. Customization, I think you have more scope with a buyout. And culture retention, again, I think is probably slightly tilted towards the buyout, because an employee ownership trust for most owner-managed businesses would be quite a shift in culture to something much more custodial. And as regards motivation across the company, I think that's probably neutral if you get it right. It can be pretty much about the same. So moving on, finally, to wrap up. Ned, in this morning's session, looked at the market. There's plenty of liquidity driving deals, wide range of lenders, private equity houses and strategic buyers who are active. Phil's looked at the disposal process, the full M&A process, but also the negotiated sale, which is really relevant because we're seeing lots of businesses getting knocks on the door these days from strategic buyers. Andrew's looked at how deals are actually being done post-COVID and some of the structures that are being used, including employee ownership trusts. And then Jan covered the topical tax landscape. So it is a good time, I think, to revisit your strategy and plan for exit and success, whether it's 2021 or beyond. It was just only in this morning's paper that the Governor of the Bank of England reckons the UK's recovery may be quicker than forecast. Now, whether you believe that or not, we can at least begin to signpost a recovery, and I'm sure we're all ready to go from surviving to thriving once again. Thank you. I think we're now going to have some questions.
Thanks, Lake. Yep, we now arrive at the Q&A. Thanks to all our speakers for those interesting presentations. I've got a couple of questions that have been received live and say a number that received pre-events. I'll just start off with one that was received during the webinar, and that was it's really directed at Ned. Is how do you go about valuing a software sort of application-based product business? Is it so typically a 5 to 7 time multiple turnover?
Yeah, good question. You're absolutely right. Tech businesses and tech sector sometimes go for ridiculous multiples that we all see these crazy valuations. What it comes down to is benchmarking the data, looking at the sector specifically, but really it comes down to the individual company. Pinpointing the value drivers, which we've spoken about, specifically in the tech business, what are the quality of earnings? You know, what's the growth rate year on year, recurring income, what's the churn like? And then the key bit which drives these multiples, large multiples, is how strategic the acquisition is for the buyer. And that's unique for each buyer. What are the synergies there? And a key one in software companies is the buy or make choice. Is it easier to buy the business or make the software comparable? So I've skirted around giving you an actual multiple, but it needs to be done on an individual by individual basis.
Thank you. Another one received today is to Jan. How does business asset disposal relief apply for sole traders and partnerships?
Again, very similar rules. There was a 10% weighted capital gains tax on lifetime disposals of up to £1 million, and that will include partnership and unincorporated businesses, and also there are entrepreneurs relief, shares in the company, disposing of the material interest in a partnership, and unincorporated businesses, but if you're also disposing of assets used in the business as well, they might also qualify for business asset disposal as well.
Thank you. Yeah, this is an EOT question, so I'll direct it to Andrew in the first instance. If I sell my shares to an EOT, how do I guarantee that the company will make payments to the trust to pay for my shares in the future?
Yeah, that's a really good question. I mean, that is one of the slight difficulties with the EOT structure. You can't have a binding agreement between the company and the trust to pay the funds across. So you are reliant on the company continuing to choose, in theory, to make those payments to the EOT. And so that is managed by ensuring that you've got the correct directors on the board of the company, and also having some careful choice about who the managers are for the EOT. Yeah, as I said, fundamentally, it's one of the weaknesses. I mean, the EOT can look at financing payments itself. So Lake touched on the fact that borrowing might be available, so the EOT might be able to borrow directly, but then it would need something to leverage. It would need something to give us security. So it's one of the difficulties that need to be planned through and thinking about an EOT, and you essentially need to be comfortable that the company will continue to be profitable and in practice will continue to make those payments to the trust.
Do you have any perspectives on that?
Yeah, I mean, just to absolutely, just to add a little bit there. Yes, there is a slight difference there. Buyouts and EOTs, you're effectively taking an IOU. With a buyout, you can perhaps have a bit more in the legal documentation to protect you, but ultimately your main protection is the people. I think if you're planning to keep some involvement in the business on the board and in management, which is possible in both, then that gives more comfort. If on the other hand you really are thinking about exiting, then that is a risk, frankly, and it's a judgment you have to take.
Thank you. Philip, so how do you see sort of deal volumes kind of progressing in 2021, given the recent budget?
I mean, prior to the budget, deal volumes, as shared by one of Ned's slides, just went through the roof, really. And we've had this internal debate at PEM Corporate Finance. I kind of lean towards deal volumes tapering off slightly, whereas I know that Lake and others in the team think that deal volumes are going to continue. And actually, what we've seen is a maintenance of kind of inquiry levels, and we're currently pitching at historic levels, and we're currently taking on new clients. So I'm always happy to be proven wrong in these scenarios. Deal volumes are continuing to hold, and I suspect they will do until Rishi and Number 11 Downing Street are more definitive on future capital gains tax changes, that's for sure.
Jan, do you have anything to add?
Yeah, I think certainly liquids, in terms of room for manoeuvre, he has very little in terms of manoeuvre. Income tax and IC is not going to change, VAT. So I think really where next, really, I think we've seen some changes to corporation tax, and I think capital gains tax. There's an OTS report which is very comprehensive, and I think over the next few years we've seen a trend. There's been generally getting good rates of corporation tax. We're still going to be very competitive. Compared to G20, it was 19%. We were the best in the G20. We're now going to be the best in the G7 in terms of 25% rates. But I think what we've seen is business owners over the last few years being a bit hammered in terms of dividends and capital gains tax. So I think they'll say, well, if you're running a business, we'll try and keep that environment competitive. Yes, we're increasing the rates, but I think they are going to look at business owners and when they're exiting. And I think capital gains tax, I think, is probably going to be something that's going to be looked at on a regular basis. And I think that's probably going to be usually 3 months, 4 months before budget. I think people start thinking, well, if I'm ready to sell, I should probably accelerate those plans, because there are going to be some changes in the future. And as I mentioned, I think 80% of people which were surveyed are expecting some changes in capital gains tax at some point in the future.
Thank you. It's almost 12 noon. It's 12 noon, but I'll fire off this final question to Lake. So if I do have an exit plan in place well ahead of time, what do you recommend doing between then and actually selling the business?
A very brief answer, thinking in terms of the clock, is probably just to revisit it regularly and see if you're on track. So whoever you're dealing with outside of the business as a kind of sounding board and an impartial observer, go back to them and say, right, here we are we on track? Do we need to tweak the plan? I think, basically.
Right, thanks everyone for answering those questions. We now close off the webinar. It's 12 noon. Thanks everyone for attending. I will follow up with just a note after this session with the recording and the slides. If you do have any questions, I'll circulate these contact details as well, so we can help in any way possible. So thanks for joining us, and have a good day. Goodbye.